I'm MaryAnn. Canadian banks ranked the world's soundest for 7 straight years by the Geneva-based World Economic Forum. They've reported their latest earnings. Did you know Canadian banks give almost half of their earnings back to investors in payouts and boast an average dividend yield of almost 4%? Today we dig deeper into bank earnings. Doug Warwick, portfolio manager for the TD Dividend Growth, TD Dividend Income, and Monthly Income Funds. Well, the banks have reported. Doug, what did you see? Any surprises out there?
Well, going into the quarter, the sentiment out there was pretty negative.
It was.
Yeah, a lot of people were, worried about oil and gas exposure on the loan book for the banks, and also the Canadian housing market, which they feel is overpriced. And I never really understood those arguments. We know that the average Canadian bank has about 2.1% of their loan book in loans out to the oil and gas industry. There might be another 2.4% loan book out in contingent standby credit. So
it's really pretty small.
Yeah, overall it's not too bad. And then the housing market. I mean, we know that half the Canadians out there own their own homes outright, and the average Canadian home has 40% equity or more in the home. So. And if a bank has a mortgage on its books, it's either insured through one of the insurers like CMHC, or you've had to go in with at least 20% down. So, I guess the surprise coming into this quarter was that Canadian banks reported, a moderately successful quarter. 4%,
maybe better than expected?
Yeah, 4% earnings growth year over year. Trading volume was good. Retail was modest but positive, and insurance, international, that sort of thing, all positive.
So what about with the Bank of Canada lowering interest rates? Is that going to squeeze margins anymore?
Well, certainly net interest margin pressure continues, and that is something that the banks will probably have to live with for the next couple of years, at least till rates eventually go up.
So were there any banks maybe that you found did better than others, or certain strengths and weaknesses that they had?
Well, so I'll take the high and the low. So Royal Bank, their earnings were up 14% year over year. Pretty good across the board. So very, very strong results from Royal. Bank of Montreal was a little disappointing. It was down 5%. I think it was probably just one-off factors like some insurance write-downs and maybe some post-retirement benefit costs that they took up front. So I don't think really anything ongoing. We did see that 4 out of 6 of the banks did increase their dividends. Okay. So TD increases annually now. Their increase was 8.5%. And then we had Commerce, Bank of Nova Scotia, and Royal each increased 3%. And last quarter we had Commerce again had increased, as well as National and Bank of Montreal. So good dividends across the board. And it was interesting. A lot of the banks discussed their stress tests. And so if you take Royal stress tests, for example, which I think is pretty severe, say unemployment went up 3%. House prices went down 15 to 25%, and Alberta went into a recession. They calculate that their loss provisions would maybe go up to 40 to 50 basis points, which would be 8% of earnings. So, in that dire scenario, not a big hit to earnings. So, I just look at the valuations of the banks, 11 times forward earnings, 11.6 times last 12 months earnings, return on equity of 16.6%, capital ratios 9.5 to 11.3%. or
All
sorry,
sound good.
Sorry, 10.3%. Yeah, and the average yield is, as you said, it's actually crept up a little bit from what you said at the beginning, with the share prices 4.1% with the dividend increases.
So when we say start here, amazing, or what seemed like very good numbers, especially with this economic environment that we have. What do you see going forward, say in the next year? More of the same?
Well, I mean, for sure, it's a tough environment. It's growth rates around the world are lower, and so the banks are no exception. And you've got interesting things going on in different asset classes like fixed income, where in say Europe, lots of government bonds are yielding negative interest rates. So when you come back and look at Canadian banks and look at the 4.1% average yield, and in addition, the next couple of years we would expect 4 to 6% earnings growth in each of the next 2 years. We think that's relatively good, considering the environment. As we talked about net interest margin pressure and the economy, but it still looks okay for the banks, I would say.
So when you are looking to add, say an investor is looking to add to their portfolio, which banks now would you say would be the best value?
Well, so what's happened is we talked about the payout ratios for the banks. Each bank has a payout ratio of 40 to 50%, and the average right now is 45%. So the banks have focused the last 7 or 8 years on getting their capital ratios up, and I think capital ratios are about where the banks want to be. So the with return on equity still in the over 16% for your average bank, the banks are still generating a lot of cash. So something like a Commerce has a strategy of increasing their dividends and buying back shares aggressively. So they have one of the best capital ratios, and trade at the lowest price earnings multiple. So I mean, that one looks pretty good to me. At the other end of the spectrum, you've got, say, TD and Bank of Montreal with their U.S. strategy. We saw TD's U.S. retail grow earnings by 16% year over year last year. So, nice seeing the U.S. strategy really starting to get in gear. I think you'll probably see this similar thing in future quarters with Bank of Montreal. They've got a nice franchise in the U.S. Midwest. And then Royal, of course, is the 5th biggest wealth manager in the world, and they should continue to grow their strategy.
All right. Thank you very much, Doug.
Thank you.
I've been joined by Doug Warwick, Portfolio Manager of the TD Dividend Growth, Dividend Income, and Monthly Income Funds. Thanks for watching.